one thing I've really loved with kind of how you guys have designed your products is, end of the day, as we're growing our wealth, you want to have less uncertainty in the investments that you are investing in. You always want to have that small amount that you want to gamble and see what happens. But the bulk of it, as we're building our lives, our career, our family, and we're preparing for future and retirement, is that you want to have less uncertainty in an uncertain market, right? And you guys have built several products, and you've got a history of creating alternatives. And most people look at alternatives as, well, it's speculative investing, right? Well, there's everything else, and then there's alternatives. The administration, SEC, are trying to figure out in this process with 401k plans of providing access to all of us to alternative investments, private equity, private credit, illiquid investments that have never been able to get access since the 401k was created. It has been primarily stocks, bonds, mutual funds, some ETFs, and has been fairly vanilla because they said that, well, it's for the safety of the public that they shouldn't be getting into alternative investments. And what we're seeing, and what we have seen, those of us who've been in more institutional markets, is that a lot of these alternatives are much safer, lower volatility, a lot more consistency than stocks, bonds, and your traditional asset allocation. Can you talk to us a little bit about how to think about alternatives as not just it's this mysterious asset class over there, but more really should be a core thesis for a lot of our portfolios? And if these 401k plans start to open up with these alternatives, how should we be thinking about it? Not really as an advisor, but how you guys see it professionally and from that perspective.
I'll start this. So first of all, I'm a huge fan of the idea. And that's not just because we happen to have some alternative products that hope to benefit. I can tell you that it is contradictory that people that have the greatest amount of net worth are the ones that have the opportunity to invest into things that have different return profiles from just stocks and bonds. So it's sort of illogical to think that the people who actually, like I think about my parents who, are retired and have a finite amount of money to live on. And I think about them not having the opportunity to participate in different asset classes that behave differently. Frankly, as JP said, oftentimes with less volatility. In the wealth management space, one of the things that you have to try and focus on is a lot of jobs a wealth advisor has. They're a shrink. I mean, somebody's going through divorce. They've got a child that's messed up on drugs or some issue or something like that. It could be somebody's selling their business. They could be having a tax problem, an estate. There's a lot of things you touch, but you could argue that the one value that a wealth advisor performs for their clients, perhaps more than any other, is they protect the investor from themselves. And the problem is that daily liquidity can be a very dangerous thing for people to make knee-jerk reactions. Everyone likes to think they're kind of smarter than most of the other people around. And so some people tend to invoke those decisions in spaces they're not that familiar with. If you're an engineer, or if you're an accountant, or if you're a truck driver, whatever it might be that you do for a living, if you're not really in the investment business, you probably ought to really, and even if you're in it, you probably got to protect yourself, honestly, from a lot of quick decision making. But I think you really want to avoid that. So what I think alternatives do is the fact that they're actually not as liquid, they're not as easily be able to sort of make those knee-jerk reactions, is protecting the investor from themselves. Obviously, the starting point has to be sound underlying strategies and investments. So we'll assume that that's a given. But I think a lack of liquidity is not a problem. And in fact, the 401k investor is a very long-term in nature investor. Their investment horizon is 20, 30, 40-year horizon. Who is better suited to invest into something that over the long haul has a better return, significantly better return at times, than someone who's very long-term focused? So I think it's long overdue. I applaud it. Now, I think there's some structural things to work through as to exactly how you go about it, liquidity and things of that sort. Someone who's nearing retirement, making sure they can get out of things. So those are the details. But in principle, I think it's a wonderful idea, and I embrace it very much. Final point, in the 401k plan, I'll let you know a little bit about investor psychology. So much as I told you, people can and do make quick knee-jerk reactions. An interesting tidbit: when I used to be in the 401k business back in the Stone Ages, you were allowed one transfer a year to your 401k. You could change your allocation one time a year. And people would say, oh my gosh, what's the date for that one change? It's like December 1st. I have to make sure I make my change. And then the industry went to quarterly. And people started saying, well, I guess I don't have to on December 1st. I might do it March 1st or some other date. And they ended up not making many changes. Then the industry went to unlimited free daily changes. And you know what happened? People never change their investments. They leave that. So the more accessibility, the less they did. Now, there are exceptions to that, and those are the people we have to protect. There are people who think they're Warren Buffett, if you want to, whatever, and they're zigging and zagging. But so there's a human psychology. So I think people who are worried about alternatives, largely, I believe 401k investors will select the ones that they want. They will let them be. They will not pay attention to the fact that they're less liquid, and I think they will probably have a far better outcome because of it. So there.